You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Mark Rzepczynski and I, Niels Kostrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Now, for those of you who are regular listeners, this podcast series is all about voicing our differences on the one topic that brings us together, namely systematic investing, using the often overlooked but very robust strategy of trend following. We hope that today's episode will trigger your curiosity to learn more by diving into the back catalog of all the episodes that you may have missed, like last week's episode with Rob, where we answered a lot of great questions from our community that had come in during Rob's vacation, so you don't want to miss that episode. And also, I would encourage you to listen to the Wednesday episode, where this week we spoke to Michael Howell about how liquidity drives financial markets based on his book, Capital Wars, The Rise of Global Liquidity, which is very relevant at this point in time. So if you missed any of these conversations, I would really encourage you to go back and listen to them as soon as you finished listening to Mark and I today. Mark, as ever, it's great to have you back this week. Another crazy busy week if you follow central banks or any kind of financial or commodity market. How are you doing? How have you been doing since we last spoke?
I'm glad it's Saturday. So just in terms of, not from what I may have made or not made in the markets, but just because of all of the swirling around of information around central banks. So I talked to some clients and said that this was central bank week, and everybody was posting new information, and I think we got a lot of clarity on where liquidity is going forward in the world, and it's not good.
It's not good. And you know the saying, of course, thank God it's Friday, but I don't think anyone yesterday felt that way, frankly, with what happened, I must say, in the markets. But anyways, as expected, the Fed did raise the overnight lending rate by 75 basis points to 3 to 3.25. And in the hawkish post-meeting press conference, the chairman signaled that they are not yet close to a peak in that rate. It was communicated that Fed funds would likely end the year at 4.25. The news rocked the Treasury market, with the 2-year note closing the week 32 basis points higher at 4.19%, just off the intra-week high at 4.25. The yield curve inverted further, closing at minus 57 basis points, not far off the minus 75 basis points seen in May of 2000. Equity investors were equally dismayed by the news. The S&P 500 closed the week down approximately 5%. And now stands about 1% above the low hit in June, with last week's FedEx news continuing to reverberate through the market. In addition to the Fed raising interest rates, the Swiss National Bank also hiked, eliminating the last negative interest rate in Europe. Traders had been looking for a 1% move, greater than the 75 basis points that the S&P actually delivered. Both the BOE and the ECB continue to strike a hawkish stance, but investors are doubtful that they will follow through with the same determination as the Fed. And evidence can be found in the currency markets. We saw weakness in those two currencies versus the dollar. The pound closed near 5% lower and the euro near 3% lower compared to last week's close. The fall in the pound intensified by the news that the UK intends to cut taxes in an effort to combat what was labeled an ongoing recession, and hit a fresh 37-year low at 109. And also the 10-year gilt yields ripped to 3.83%, up from 3.5%, the largest one-day rise since at least 1989. On the other side of the globe, the Bank of Japan continues to be dovish, on the other hand, reaffirming their commitment to holding interest rates at artificially low levels. That policy has caused a nearly 20% devaluation of the yen versus the dollar. And in an attempt to stem the decline, the BOJ intervened, buying yen for the first time in over 2 decades. Of course, many other central banks raised their benchmark rates this week. As we close out the week, the markets don't feel anywhere near equilibrium. With that, investors should expect volatility to continue into the quarter end next week, and most likely for a lot longer. Mark, let me bring you back here and just for you to talk a little bit about one of the things that you've been noticing in the last few weeks since we last spoke, both either from markets or from your kind of trend following lens.
Well, the thing that really sort of strikes me is the moves in the currency markets, because we now have what I call currency vigilantes. It used to be that we talked about bond vigilantes, that that they would sort of slap reality into the face of policymakers. But now we have the currency vigilantes that are telling you that some central banks are still behind the curve, and some other banks are obviously going to continue their hawkish policies. When you look at the dollar as an index, it's up close to 17, closing in on 20%, gains for this year. You look at the yen, it's well into bear territory. And if you look closely, is that the BOJ has not changed its policies, but they're so worried about what's happening now with the yen. This is now they intervene, and that was intervention has always been thought of as a failed policy. This is that there's been a lot of research in that area. It was much more actively used in the 80s, and then they stopped doing it because they said it just doesn't work. If you intervene and don't change your underlying monetary policy, you're not going to have any effect. And as a central bank, you're going to lose money on those trades. That's where the environment that we're in. But you just look at the pound. You look at euros, you look at all of the currencies, they're clearly telling you that the rest of the central banks around the world are behind what the Fed is doing, and they have inflation that's just as high as in the U.S. or somewhat higher. So in some sense, a lot of the trends that we're seeing are going to continue. Some people have started to talk about, well, we're oversold to some degree. You can't be oversold if, let's say, the fundamentals are still in one direction. In fact, that's why I sort of focus in and look at fundamentals, because if you look at technical graphs, you could say, like, look, these markets look like they're overextended. But then you look at what's going on the policy side, you say this could continue on for quite a while.
Yeah, you know what? It's interesting when you were talking about that, and obviously with the pound hitting 109 this week, it kind of reminded me that I think that in September, I think we're exactly 30 years since the pound was forced out of the EMS, as it was called back then, on that, I guess, George Soros breaking the the pound or whatever the story is. So that's an interesting coincidence that we are now back to really extreme low levels now. But also I think that what you're saying about the currencies, I think people have somewhat forgotten what happens when you really get these big, massive forces out. And what I mean by that is that in the last 20 years or so, between central banks, policy has been quite coordinated because they've been more or less in the same situation from an economic point of view. And that means that there hasn't really been lots of things going on in the currencies. I mean, for trend followers, I don't think we have, as an industry, have made much money, if anything, in the currency sector up until this year for at least 10, 15 years. But these big forces, especially when it happens and it manifests itself in currencies, it actually has a ripple effect into many, many other things. And so what I worry about a little bit is that there are so many people sitting in a portfolio management role today, even at big pension funds, and they have no experience with inflation. They have no experience with these kind of moves in general, let alone big currency moves. And many of these quote unquote experts have all they've been doing is been calling for some kind of Fed pivot so that things could get back to normal and we would get back to our 2% inflation target and so on and so forth, and everything would be fine. So my worry is that there's going to be some fallout from this lack of experience, so to speak, and maybe this is really just the beginning of that. It was interesting to me, if we just stay with the trend following theme this week. Of course, it's been a solid week, I imagine, for the trend following industry. That's certainly what the indices suggest. And of course, once again, it's been the fixed income markets and to some extent the currency markets that have been, leading the charge, so to speak. Maybe with a few other sectors, but frankly, I think most of the risk budgets are being focused in these two quote unquote trends. And interestingly enough, again, we heard out, and you and I think, spoke about it a little while ago with JP Morgan and Nomura coming out at the end of July saying, oh, but trend followers had gone out of their short fixed income trades and now they're positioned in for something else and what have you. And I think we all agreed that no. I mean, if we look at our positions, there's nothing to suggest that we have any long signals coming in the near future in these sectors. And I think that's another thing why people should be very careful what they read in the mainstream media about what trend followers are doing. And we're going to talk about that a little bit later with some other research that has come out in that direction, so to speak. But anyways, it is definitely interesting times. Unfortunately, it's also very painful times for many traditional investors, but at least for those who did make the jump into trend following, there has been some good news this year so far, at least. My own trend barometer is finished at 55 Friday, so again confirming kind of a positive month so far, at least for trend followers. And if I just briefly, before I bring you back, Mark, talk through the where we are on the indices, the Beta 50 index, and that is as of Thursday. I think Friday was a good day. I certainly expect that to be a good day. But even as of Thursday, we're up 2.3% for the month, up 17.3% for the year. SocGen CTA also up 2.3% for the month and 24% for the year. The trend index up 3.5%, almost up 32.6% for the year. And the short-term traders index up 75 basis points and up 11.93 so far this year. And contrasting that, we have the traditional markets, the MSCI World Index down 7.19 so far in September, down 24.5 for the year. The World Government Bond Index down 2.62% for the month, down 12.58 for the year. And the S&P 500 down 6.62 for the month, down 22.5 for the year, well back in the bear market territory. So just a little bit of insight from the trend following world, I guess.
No, it really is. I don't want to use the word scary, but unusual, because I look at I run for a lot of markets. I'll run a short, medium, and long term trend following, just indicator, and just to sort of give me. Can I have a flash look of what the markets are doing? So it could tell me like a little dashboard that's telling me exactly what's going on. And you have everything in the equity markets and equity indices in the U.S. and countries and sectors, they're all short. You look at everything in fixed income, it's all short. You look at everything in currency markets, there's one or few emerging market currencies that maybe in long-term trends that hasn't moved through, but everything on the G7, it's all short. You look at fixed income across the U.S. and it's short. Energy markets, you're short across the board at all different time frames. And so it is a little scary when you see everything positioned all in one direction, all sort of following a single narrative. It worries you because then you say, like, well, is this crowded? Okay, which we could talk about crowdedness a little bit later. But it also tells me is that if there's some information that changes expectations from this negative viewpoint, is that it could be painful if you're trend following right now. But it's seldom that you see the situation where you're going to be so short in a lot of major markets.
Yeah, I mean, it's interesting you bring that up. It kind of leads us into one of your first topics, but we have a question that came in that I need to ask you beforehand. But just as a little brief comment on that, I think a lot of people who are doing models like that will get exactly the result that you have. But all I want to say is, from a practitioner's point of view, that is not how our portfolio looks like. We are not short across everything. And frankly, we have very little exposure in things like equities, because it's actually a little bit of a mixed bag, et cetera, et cetera. So this is where I guess we all do trend following a little bit different. And so we end up with different positions. But I agree, if this continues, probably at some point, most trend followers will end up having a very short exposure across the board, just like we had earlier on this year. Maybe with I guess if you say we were long the dollar, we would have had a very long exposure, with the exception of fixed income, perhaps early in the year, because all the commodities were going up at that time. So, but it has been an interesting year, and there has been a couple of transitions, of course, but they've been kind of dampened by the strong trends in a couple of the sectors.
Now, when I sort of use this as a dashboard, that's not accounting for volatility, that's not accounting for portfolio structuring. It's just sort of say, let's look at some simple, trend indicators and look at what's going on. And so that's what you really sort of pay for when you buy a manager, because you sort of say like, okay, I see a lot of these indicators, but now how do I sort of account for volatility? How do I account for the fact that I want to have diversification within my portfolio? And then I also have to account for how do I manage that risk in terms of perhaps stop losses or other mechanisms to sort of reduce my exposure when everything looks like it's all pointed or leaning in one direction.
Now, you are not familiar with this question, but it just came in from Matthew, and so I just want to quickly ask you about this, because it is kind of relevant when you think about what the times we're going through right now. So Matthew writes in, I have a question which may or may not be worthy of the weekly Systematic Investor podcast. Of course, Matthew, all questions are worthy. And he writes, I was wondering about the risk of trend funds in the event of some kind of global financial reset event, since the fundamental deal in the futures is there any risk that these contracts may not be honored at such time? So what you're talking about here, Matthew, is a kind of systemic risks in the clearing broker community, futures exchange community. What are your thoughts? We've obviously seen some firms over the years, MF Global, to name one, go under. What are your thoughts on these things, Mark?
Well, I was around for MF Global. I was around for the 87, crash. I was working for the Mercantile Exchange at the time. And just a sort of side story is that there, behind the Board of Trade, there used to be some pawn shops, because it was a little bit of a seedy area, underneath the subway system there. And the night of the crash is that they had policemen on horses sort of working with the mob of people outside the pawn shop that were trying to sort of pawn off their watches to make margin calls. And that always vividly stuck in my mind, because as I was walking through the area. So that's what you call a liquidity event. But we'll say that since we've had these crises, I think we've done a much better job of thinking about systemic risk, managing systemic risk, and trying to plug holes within the system where there could be leakages from failure. So I think from a brokerage community, we've done a better job. We'll sort of say the risk management at the exchange level is much better. At the same time, is that we'll sort of say that as the quality of our risk management has improved, at the same time was that we've taken a strategic view, and this is policymakers around the world, is that we want to place more and more risk on exchanges so that we can actually be able to monitor, see it. We could then have the clearinghouse be able to control that risk and control the margin process. That's a good thing, but at the same time, is that we've taken a lot of little risks, which may have a higher probability of something blowing up, and we sort of said we're all going to put it into one place. If you do it right, that should reduce all the risk. At the same time, is that you have more risk concentrated, but that's more of a theoretical, so that there's some possibility that it occur. But we'd sort of say, in general, that the futures exchanges, futures markets in general, have done a better job of managing risk over the last 10, 15 years than I would have imagined. So the risk that there would be a systemic failure is less. At the same time, is that was there say for a given institution, could there be failures? Absolutely. And the one area that we want to try to highlight is, trade financing and financing of commodity houses, especially in the energy market. When energy was getting up to well over $100 a barrel, you had you think of the same cargo of oil was significantly larger in terms of dollar value. The risks that you have to put up for margin, for insurance are greater. The amount of money that energy companies that are hedging have to post for margin is greater. So there could be a liquidity failure event for commodity firms, given the fact that they have to post a liquid margin with sometimes illiquid assets.
Yeah, no, absolutely. I also think, and obviously have no way of knowing this, but I have a feeling that if there was a major exchange in having an issue, a futures exchange, I would have thought that they are regarded as systemically important, just like a JP Morgan or whatever. So I would have thought that there would be some efforts to make sure that didn't actually play out, because that would not just be a Lehman moment, that would be like a Lehman moment times 1,000. So I think it's what's interesting is that with the futures markets, they have proven, historically at least, to be incredibly good at upholding liquidity during all of these crises, much better than even the foreign exchange markets that are, claimed to be the most liquid markets in the world. I mean, they certainly weren't liquid during some of the crises we've seen, both in, I think, remember from 2008, but also remember some of the days during the COVID crisis where futures were, I wouldn't say unaffected, but they were certainly liquid enough for people like CTAs to do their business. That's for sure.
Now, the real issue, when we look at from what we've learned from the pandemic in March 2020, is liquidity, because liquidity is sort of like the canary in the coal mine for a margin crisis or a failure crisis. So we did have liquidity problems in the treasury market, in the cash market, which then spilled over to the futures markets. People weren't able to put on the hedges. They weren't able to find the collateral that they needed. And this is where they really had a problem. Now, I think that the Fed and other central banks are aware of liquidity issues. They know that they have to provide liquidity as the lender of last resort. But when you look at the problem of what is the amount of inventory that dealers hold relative to the size of the market and the size of trading, we just don't have a lot of market makers in cash markets, and we don't have a lot of market makers in general to provide liquidity to markets. That means that we could have large moves that are that maybe started from a information event or some event, but will be extended for the simple reason is that we don't have liquidity providers on the other side of trades. Liquidity is a problem.
Yeah, and which actually was very interesting because we earlier this week published this episode with Michael Howell, which is all about liquidity and also capital wars in general. So it's very apropos these times. So if people haven't listened to it, they really should go back and hear what he has to say.
Which is, I love the work that he does, but there's two levels of liquidity. There's the liquidity that's provided by banks from credit, okay, which is the flows of capital that across the world. Okay, we have potential problems in liquidity on capital flows and money needed to, let's say, hedge dollar exposure. But there's also they will call that macro liquidity. Then there's also micro liquidity. The micro liquidity is that when I want to trade an instrument, is that do I get the fair price at that time? And the reason why treasuries are considered a safe asset is because that you will get, when you go to the market, you will get the fair value price when you look for a price of immediacy. If you can't get a fair price immediate when you want to sort of buy or sell, then you have gridlock. You have potential for failure, and so it's the micro liquidity that we're worried about. Your last week's call was about macro liquidity.
All right, well, let's move on from the question to your topics that you brought along, which looks very interesting. And the first one is a research paper that I've not come across before, I have to say. It's from the Swiss bank, UBS. It's titled CTAs, How the $375 Billion Influences Global Assets. Yeah, very interesting. I read it a couple of weeks ago, and I wasn't actually expecting you to bring it up today, so I'm glad you did. And I'm curious to hear what you take away from this research. A lot of people worked on it. It seems so, and maybe it's something they're going to continue to publish. I have a feeling it is, but admittedly, it's the first time I've come across it. So, what are your takeaways from this quant piece or CTA focus piece from UBS?
Well, this is from their Q series, which is from their quant group. It's a 57-page report. It's first talking about CTAs in general, and then about how to extract signals. So the reason why you listen to podcasts is because you don't have to read the 57-page report. This is it. Hopefully, we can boil it down to something that's reasonable. Do, yeah. So I had a friend client that I've been working with. He said, "Oh, have you seen this UBS piece?" And I said, "No, I haven't." He says, "Oh, you got to read it. It's really interesting." Now, he's an equity guy. He's not a trend follower. He's not he's not focused on this kind of markets. And he said, "Oh, I read this is really really important, I think." So I read it myself, and I was disappointed, and because at this point in time, given all the podcasts we have and all the and you sort of say this is a $375 billion market, is that right away UBS gets wrong the difference between a CTA and a trend follower. So they said, let's talk about CTAs. So, and then what they do is then try to explain all the value of what trend following is. So if I think it's the one thing that you get from this podcast is that trend followers are CTAs, but not all CTAs are trend followers. This is it. It's a mantra that you got to remember, because people are still confusing the two. The second is that they talk about CTAs, meaning trend followers, as momentum traders. And again, this is that trend following is not momentum. There is a difference between the two. And trend following is an absolute strategy. So where you're looking at absolute returns and you're extracting it from the behavior or prices. Momentum is a cross-sectional relative value strategy in the traditional sense of how we think about momentum. And so what happens is that right away is that if you're an unaided reader, you're confused about what exactly you're talking about, when in reality what they're sort of saying, trend following has value, and but trend following is not momentum. It's price-based absolute strategies. What they do, which is really good, is that they, again, sort of walk through the battery of tests to show the value of CTAs. They call it CTAs, but trend followers, is that Sharpe ratios are good over the long run, although there are periods that they'll underperform, which we really already know. Diversification from trend following is very strong. Is that the correlation of equities is 0 or slightly negative, with bonds positive. They can reduce drawdowns. They can provide tail hedging, or they can reduce exposure because they do very well when. And what they do is they look at a different way. They look at the persistence when there's an increase in real interest rates, and they say that. I think their conclusion is that if you look at the 6 out of 7 times when they indicate there is a greater than a 9-month increase in real rates, is that you get positive returns from following trend followers. So it's a slightly different take on how to cut the data to show that they still offer, good value within a portfolio. And then they show exactly is that if you add, trend following to a 60-40 portfolio or equity portfolio, you will get lower risk and lower drawdowns. But then what they do is that their main part is they say like, well, look, these are really important managers. These are important strategies. It's a big market. So what we're going to do is we're going to try to sort of extract out what are the signals that come from CTAs. And so what they do is they actually say, well, we're going to take some exponential moving averages, number of different time frames. We're going to look at some crossovers. We're going to then be able to come up with signals for each market that they believe CTAs trade. Then what they'll do is they'll Z-score them. So they're going to sort of weight them by volatility and convert them into signals between -1 and 1. And from that, then they could be able to sort of say, using some liquidity and portfolio adjustments, say, this is what we believe are the positions that CTAs currently hold in the market. And then what they say we could extrapolate and say, this is what we believe that CTAs will be positioned like in the next 2 weeks. And then what their objective is to say, well, we can report and tell you what CTAs do. We could tell you what we think that they're going to do in the future. And we think that this does a better job than Commitment of Traders reports, which reports positions of large traders at U.S. exchanges. So in some senses, that their overall objective is to say, like, CTAs are really good. And so what we're going to do is we're going to sort of replicate trend following strategies, generate signals, and then we're going to provide a monthly report to tell you what those signals are and say, this is how they're positioned, this is what they do, and you could do this too.
Yeah, I mean, when I read the report a couple of weeks ago, I also got very excited in the beginning because I thought, this is great. I mean, here's yet another investment bank that is now clearly embracing trend following, telling all their clients how great trend following is and why they should have it in their portfolio. Of course, these things happen often after a good period of performance, and then you hear nothing for a while. But we'll take whatever we can get in terms of praise from these investment banks who clearly control a lot of client flows. But that being said, I do not understand why there is this fascination of then trying to, just like Nomura, just like JP Morgan, it's not just UBS, let's be clear, trying to, although I will say I've not heard the others talk about what CTAs would be positioned for in 2 weeks' time. I mean, it's this weird desire to kind of almost front run CTA. So, okay, let's agree it's a great strategy. Well, why not just allocate money to the strategy or build your own trend following models and compete with us? Why do you have to come out and saying, oh, listen, we can predict now what they're going to be positioned like in 2 weeks' time, so you can just follow that and position yourself like that? I mean, how can you predict something that even we can't predict? Because unless you know what the markets are going to do specifically for the next 2 weeks, you have no idea what positions we're going to have in 2 weeks' time. So it surprises me that there is this focus on that. And I worry for people who may not be listening to us every week, that they might eat it raw because it comes from a big investment bank saying, oh, they must be right. They must be able to do this. And I would suggest that this is not a good way to look at trend following. But I do agree, by the way, with your, and I think it is important that we distinguish this point about that not all CTAs are trend followers, but trend followers are CTAs. I think that is a very important point.
Now, given a $375 billion market, this is that Wall Street and the London City are always going to behave as that there's a big pot of money there. How do we be able to sort of extract some of that for ourselves? So now, banks are already competing against trend followers as a business because they already offer, we'll call it trend following surrogates in the alternative risk premium swap business. So you can go to a bank and they will give you a set of rules of a trend following model. And they would say, we'll put it into a swap form and then we won't charge you any incentive fees. What we'll do is we'll just charge you, a fee on the swap. And then you can be able to notionally fund this and be able to put this in the portfolio. So they're already generating swap business. And there's some French banks that have, we'll say, sizable in terms of billions of trend following swap products available. They're also competing by saying is that, like, look, we can tell you what the signals are. So if you think that if you like this strategy, we'll give you the signals. So it's important then to sort of say, like, well, what is the distinctive value of having a money manager or a firm manage your assets versus doing it a swap? Because a swap is, in some sense, a passive investment. It follows the rules, and no matter what happens, it is not going to change unless you sort of sell the swap back. So what you're looking for when you buy into a firm is the fact that they can do ongoing research. They can be able to adjust models. They can get execution value. So they can be able to add or subtract markets based on whether they think that there's a need for more diversification or they feel that some markets, don't work for trend following. So there's a whole set of dynamic behavior that you get from a firm that you don't get with, let's say, passive trend following and investing. So others could sort of say, no, I want that passive index because I know exactly what I'm getting. So, but I think one of the things that I take away from listening to the podcast and from my own view of the markets is that markets are dynamic. They constantly are changing. And the structure of markets are changing. And so it always requires ongoing research to try to sort of say, how can you be able to enhance or further develop your edge in the marketplace?
Yeah, and the other point, I just maybe we'll move on to the next topic you brought along. But the other point I wanted to mention is that, a lot of the CTAs are good clients of these investment banks. So why is it you have parts of your bank trying to compete, even trying to kind of take business away from your own clients? Why don't you instead have a business model where you actually try to help your clients by, finding investors for these funds that are paying you well every year for doing business with you? It just strikes me as a very weird policy. But of course, I'm biased in this case, I guess.
Well, the main thing, though, is that if you read this paper, it has some good takeaways, on just what trend following can add value. I think that even in the 90s and even in the 80s, banks are constantly trying to reverse engineer trend following signals so they could be able to sort of look into what CTAs were doing and seeing if that could give them an edge as market makers. And in some senses that if I'm a market maker, I would want to know what CTAs are doing for the simple reason is that if someone calls me up and says, okay, I want you to be able to execute this amount of trade, this is it. I'd want to know is that all of the trade? Are they trading full, or or is there a lot more orders behind that? And am I going to get steamrolled if I let's say I'm a market maker and I take the other side of that trade? So there is a sort of a gaming strategy between broker market makers and money managers, where you're always trying to sort of say, can I anticipate what the CTA or trend following is doing, so I can be able to position myself to either reduce my losses as a market maker or potentially increase my profits. So there is a gaming aspect of all of Wall Street with every strategy where someone's trying to reverse engineer your strategy to sort of be able to figure out how I can be able to profit from that flow.
Yeah. All right. Well, speaking of flows, you brought another topic that you wanted to talk about, which is the global fixed income markets and what's been happening at the moment in the last couple of months, but certainly intensified this week with coordinated central bank policy and now even some some other actions from at least one of the central banks. So take us into that topic and let's see where we go with that.
Well, I think that the important point here is that and which we've already touched on is that there's tremendous amount of coordination of central banks. All of them are behind on inflation. All of them are following the same strategies, so that when you move from and I think a recurring theme in the way I view markets is that what are the underlying macro trends and how are those displayed in prices? So we have a clear market trend of coordinated central bank behavior. And we know that they're behind the curve relative to inflation right now, so that we should expect that there will be price trends that will be coordinated around the world. I mean, coordinated, they're going to be correlated. So correlated trends will happen. And so you should expect that the bond market, the gilt market, the treasury market up along the curve are all going to be in the same positioning. And so we'll sort of say that the narrative leads to sort of correlation and trends. And that's what we're seeing in the marketplace. And that's what we're seeing, especially in this week in all the central banks. And what you find out is that when the Fed raises rates, they're attempting to actually, in some sense, export in inflation to other countries. So other countries, in some sense, to stop inflation from occurring in their country, have to also raise rates. So in some senses, is that you have an arms race or a game going on. Is that Fed wants to export inflation, they raise their rates. They say like, what do I have to do? Well, I see that there's depreciation in my currencies, which means is that my imports are going to be more expensive. So now I'm going to have to raise my rates because I don't want to take in this exported inflation. So now I got to raise rates. And so what happens is that you actually create the foundation for a global recession, because we're coordinating the behavior of central banks to all raise rates around the world. And what may seem rational for one central bank when done across the board could lead us into a global recession. And we could sort of say we get the indications of that when we look at commodity markets. So while we look at commodity trends, at the same time is that they're giving a forward expectation of what might happen to markets. So look at oil markets. Oil markets are now under $80 a barrel. This is that if you would have said we just had 300,000 Russian conscripts called up, Ukraine war is still going on. You look at you still have an energy problem in Germany and the rest of Europe of like, how are you going to heat your homes? And if someone said, well, given all that information, what do you think is happening to crude oil prices? You would not think they're going to, they're at $78 a barrel after being at 110 to 120. So we have a more than a 20% decline in oil prices while we have a geopolitical crisis. So this is clearly telling us that there's a decrease in aggregate demand, where there's just people don't need energy right now. So markets are forward looking.
Yeah, there's a lot of stuff going on in the energy markets and commodities in general. And actually, I just want to sort of flag that on Wednesday, we're going to publish a follow-up conversation with Adam Rosenzweig, which was one of the most popular conversations we had in the spring, where he went through the whole sort of commodity situation. And we continue that conversation with the focus on energy next week, but we will do a further follow-up with Adam a few weeks later, because there are many other parts moving in that. So definitely stay tuned for that. We talked about earlier about the trends in the same direction. I don't know if you have any more things. I noticed that as one of the topics, but then there's also something that happened this week, which we haven't seen for a long time, which kind of links a little bit to the whole issue about central bank policy. But we did see the Bank of Japan intervene the currency market this week, which is something we, at least those of us who've been around for the last 30, 40 years, was pretty normal back in the day. We haven't seen it for a while. So it's interesting that we are back to that instrument being used by central banks.
And this is where the internal, we'll call it monetary policy, what you'd like to have is that you continue to have loose monetary policy because you want to try to, get inflation higher. You want to try to get growth higher. And at the same time is that it then intersects with the fact that you're not isolated. You're part of a global economy. And so you sort of see that the yen has been a tremendous bear market. Is going to 146. So they say, like, well, how do we stop this? This is it. And they say, like, well, maybe if we intervene in the market, we could stop the speculative excess. And it usually works in the short run, instead of intervention. So most of the research that we go back, it's sort of old because there just hasn't been a lot of intervention. Shows us is that you can dampen volatility, you'll have a short-term impact. But usually then, if you say that the underlying policy is still the same, this is that then the trend, you're going to go back to trends. So we just sort of say that I think there was a little strengthening of the yen, but say, like, if there's no change in policy for the BOJ, is it, and the rest of the world has higher interest rates and they're having more hawkish policies, is that you can't sustain that unless you're going to start to use up all of your reserves to try to sort of manage that currency. And I don't think that we're ready for managed exchange rates just yet.
No, and I wonder if there's a little bit of a link in some of the treasury sell-offs and the intervention, actually, because if they're buying yen, they're probably selling dollars, and they might have to sell treasuries to sell those dollars. I don't know. I was just thinking about it while you were talking about the intervention, because it has been quite a ferocious week for U.S. treasuries this week as well.
Now, I would sort of say that I was engaging in the cognitive dissonance of following the markets really closely as a macro guy when I should just be looking at trends. And so if you look at the Fed meeting, this is that Fed comes out 75 basis points up, market sells off a little bit. Then Chairman Powell has his presser, and all of a sudden he starts talking, and the market starts rallying. It's almost like you said, like, okay, I'm listening to the words, and people are interpreting it completely different. That he's not as hawkish. That they're sort of saying is like, look, I think that there's something positive here. So then they really sort of had to say, like, okay, let's like digest what we just heard and what we've seen from the dot plots or whatever. And then that's when the market sort of, started to sell off hard. And from a trend following perspective and a macro perspective, you say, like, yes, we got the 75. It could have been 100. It fell within expectations. So there shouldn't have been as much a reaction because the market should have already discounted that. But what they didn't discount is the fact is that, look, we're looking at, well above 4%, 4.25% by year end. We're going to go even higher in 2023. We might start to sort of see rates fall in 2024. And then you sort of say, like, well, if the Fed through their dot plots is telling me that we're going to have above 4.5%, rates, and they've been still behind the curve, but that's their best estimate. This is that, if I'm a fixed income guy, I'd say, like, why the heck am I holding these bonds? And so that's what, so is dot plot, reaction, which is forward looking. And then now if I'm a bond trader, say, like, well, if that's really what they think, then I've got to act accordingly.
I was reading one of the Danish newspapers a week or two ago, and the largest public pension plan in Denmark published their first half results, and it was shockingly bad. I can't remember specifically how many percent they had lost, but it was significant. And I actually think from memory that there were some articles out towards the end of last year, early this year, where they had come out saying, well, actually, it's so hard to get any real return, so we're going to take even more risk heading into 2022, which of course couldn't have been worse in terms of timing. But it does, as I mentioned earlier, it does concern me that you may have a lot of these quote-unquote long-only type investors of real size, but also of real consequence from a societal point of view, if their assets get shaved by 50%, because they weren't just losing money in equities, they're now also losing money in fixed income and private equity and what have you. Everything is going the wrong way, because frankly, most of them don't have much exposure in things like in uncorrelated strategies like trend following or something else, of course. So there is definitely there's going to be a fallout of what's coming in, and I think it could also exaggerate the moves. And listen, I saw a Bloomberg conversation this week with Jeremy Grantham. I think it was recorded maybe late August. I don't know, can't remember. But anyways, he's obviously been bearish and talking about this bubble, which to his credit, they have forecasted the previous bubbles, except for the fact that they're always early, and he admits them always being early, and sometimes it kind of almost cost them a lot of clients because they're too early. And they were early this time as well, because they each started talking about this a year ago. But if he's right, like he ended up being the last few times, I mean, what we're looking at right now, according to him, is only the beginning. I mean, the bubble has not even burst. And there is one thing that is quite interesting that I'm noticing more and more of these people that I would consider as being, people that's worth listening to. A lot of them talk about how orderly it has been in the equity markets. There's no sense of panic or anything like that, even though we are, in a bear market territory, but it's all been very orderly. Look at what volatility is doing. It's not suggesting any panic either. So maybe there isn't really any panic yet, and maybe the panic is all to come going forward at some point. Like the ECB's Schnabel was out saying that we're moving from the great moderation to the great volatility. This could be some interesting times, and certainly for strategies that are directionally based and not predicting anything. It could be, and that's the other thing actually I wanted to say is, and I don't know how you feel about this, Mark, but of course, CTAs get a lot of attention right now because returns have been so strong in the last 18, 24 months, maybe even. But who's to say that they can't continue? I mean, I think it's almost like with the Fed pivot, I think some investors will sit back and feel, well, maybe we missed the boat. Maybe we should have bought CTAs 12 months ago. We didn't, so it's too late. Well, maybe this is just the beginning of some kind of long period of above average returns after a period of time where certainly from 2015 to 2019, including those years, returns were below average. What are your thoughts on that?
Well, I think that you have to look at the forecasts, and so I'm sort of recasting your question. You look at the forecasts of what we're seeing is that the Fed actually thinks that we're going to have 1.7% real GDP for 2023. We're going to have, unemployment, 4.1 to 4.5%, and PCE inflation at 2.8%. So they're sort of forecasting a Goldilocks economy. And so what you really have to sort of say is Goldilocks not going to occur? So what happens if just things are worse than what they expect? So you say, so let's go back and sort of say, how good a forecast has the Federal Reserve been with their SEP forecast? They've been horrible. This is it. If they were working on a Wall Street bank, they would be fired. And so the real question is that, are we not cognizant of the fact that we're hoping for a world that may not exist? And if the world that we would like is not the world that we see, then there's going to be further adjustments, and that means that trends could last a lot longer than expected. And I think that's a reality that we are going to face in 2023.
Yeah. Now, just for time constraints, a little bit on my side today, Mark, of the last remaining topics, is there anything you want to sort of highlight you think is appropriate just to round things off with?
Well, the one thing that I wanted to talk about, and this could be a longer discussion, and depending on what your listeners think, is that I've been reading some of the work of Ari Kruglanski. So he's a psychologist. He's now working on, sort of radicalism and terrorism. But he spent a lot of time looking at something on dealing with how people deal with certainty and uncertainty. And what they did is they said, like, that people have a need for closure. Okay. And there's that you could actually classify people on a spectrum based on their need for closure. Some are want to have a lot of closure. That means that they don't want to have open-ended questions. They want to be able to have definitive answers. They like to have yes or no. They don't like to live in the area of gray. And so he actually came up with a set of questionnaires to be able to sort of determine your need for closure. And what he said is that the people who have a need for closure don't do very well with uncertainty. Okay. Because you got a lot of different information, you got conflicting signals, and so therefore is that they're stymied by that because they want to have an answer. They need to say, what is the answer, and there may not be an immediate answer. Those who do not have a need for closure, they're actually better prepared, or are better able to deal with uncertainty. So. And so we're all in a spectrum. And so if I gave you the quiz, or you took the questionnaire on your need for closure, you would be some point on that spectrum. I would be at a different point. If we had other people, we could get different levels of closure. And then I sort of said to myself, like, well, does that have anything to do with how I behave, or what a quant does, or what a trend follower does? And I would probably posit as a hypothesis is that those people who want to follow models, those people who, are quant focused, are probably have a greater need for closure than those who are more discretionary traders. So that a model is our attempt to how to deal with our need for closure. So because if I'm a trend follower, and if I say, well, trends are up, so therefore I'm going to be able to buy in a very simple way, is that closes the issue. I now can I could take comfort with the fact is that I've made a decision, as opposed to when you think about even this Fed decision on Wednesday. I'm looking at the screen. I say, okay, here's the announcement. Here's the reaction. Here's Chairman Powell. He says something else. What does that really mean? Here's the dot plots. What should I do there? Here's the SEP forecast. How should I use that? So I don't get any closure when I look at all of that random information. That we use models as an attempt to gain closure in our trading environment. And so, and those who, and your level of complexity of models may have to do with your degree of closure that you need, or how much that you want closure to be sort of simple or more complex. So,
could you take it a bit further, actually, by saying that the paradox is that most people tend to shy away from trend following because they feel there is no certainty in what we do? And we say that in ourselves because we say we have no idea what we're going to do. We don't know how we're going to react, and so on and so forth. So I get the sense of what you're saying. I kind of recognize the fact that for us, it's comforting that we have our models, our rules to follow. And maybe we can say, yeah, that gives us some kind of closure in an uncertain world. But then I would argue that most people would take more comfort and more closure from someone saying, well, I think the Apple's going to produce a $2 billion revenue in Q4 and the equity price is going to go to 150, rather than the CTA saying, I have absolutely no idea what's going to happen. I'm just going to follow my rules.
Well, I think that the CTA said, I don't know what's going to happen in any given situation, but I do know that, or the assumption is that I can't predict the future, but I do know that if I'm a trend will usually continue. So therefore, is that my closure is the fact is that a trend will usually continue. That's my underlying assumption, and so I do have problems with people say we're non-predictive. Yes, we are predictive. We are predictive that the price momentum or price trend that we see will continue, and that's what we're actually trying to exploit. If you really believe that we're non-predictive, then you believe that prices are always random, on the next day, and you don't really have anything to say about tomorrow's price. So I actually believe that we do have something to say about what the market.
That might be true, but we would keep that very internal, right? We would never go out and say, well, we think the markets are going to do this. That's what I mean. But anyway, it's an interesting conversation. I'm sure we'll come back to it. And it is interesting how these psychological issues, of course, we know they're incredibly important when it comes to investing. And deep down, we believe that human behavior is something that we can exploit to some extent through our strategy. So therefore, psychology is relevant because that's certainly part of what makes human behavior.
Right. So psychology affects, you'd say, well, I'm agnostic. I'm going to build a model, and I'm taking out all of the biases, and I'm taking out all of the psychology when I build a model. And that's wrong. Is that when you build a model, is that you're actually embedding a lot of your own psychology into that model. The fact that you're saying that I'm willing to sort of play the odds through a model is telling you something about how about your psychological makeup. And I think that this is what you're trying to get at with you need to for closure is that there's nothing wrong with that. Is that given how I'm wired, may say is that I'm more comfortable with building models and having signals that give me a definitive answer than someone who said, well, I just want to have all the information gathered together and then I want to sort of then process it. So I always remember the story is when I first went down to the floor of the Board of Trade is that you sort of see the visitors gallery and you sort of see all the craziness and I always say there's only two reactions. There's one people have abject horror and say, I would never want to do that. And other people sort of say, this is really interesting. I got to be a part of it. But then once you say, I want to be a part of it, then you have to say, well, how can I create an edge? And I probably sort of said this is that like floor trading or just using my wits to trade. I knew pretty quickly that's not who I was. That's not my makeup. That's not how I could be able to create an edge. I had to sort of get some closure through a model. And so I said, that will give me my edge because I can't get it by just living by my wits. And I think that that knowing yourself will then determine exactly how you sort of should trade.
Absolutely. No, absolutely. All right. Well, let's wrap up our conversation today. Just a couple of things that I'd love to ask our wonderful community to help out with. One is, as I've mentioned before, if you could leave a rating and review. If you go to toptradersunplugged.com/review, there are some suggestions as to how you can quickly leave them at the various platforms. So that would be super, super helpful for us. And the other one, of course, would be maybe to go to and share a link, toptradersunplugged.com/share. If you send that link to 3 or maybe 5 of your like-minded friends, colleagues, family members, that would also be a great help for us here at TTU. Next week, I'm joined by Alan, so I'm sure we'll be tackling some really interesting topics as well as a review of the month of September. I have a feeling it's going to be a September to remember already, so make sure you're going to tune in for that. Send us your questions, info@toptradersunplugged.com, and we'll do our best to answer them. And of course, you can always check out the website where we publish blog posts and, of course, the monthly review that Rich and I do on the trend following industry and much more. From Mark and me, thanks ever so much for listening, and we look forward to being back with you next week. Until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.